Welcome to This Explainer. If you've ever found yourself wondering how some companies seem to just magically multiply their profits, or on the flip side, how they manage to crash spectacularly during even a slight economic downturn, well, you are in the exact right place. Today, we're exploring the core concept of leverage in corporate finance. It's a fundamental mechanism, really, that, when you properly understand it, totally unlocks the secret behind a company's true earnings potential. So let's get right into it.
Okay, let's dive into this. We've got a great roadmap today. We are going to cover the concept of leverage, then decoding operating leverage, understanding financial leverage, the combined leverage multiplier, and finally, we'll wrap up with their significance and limitations.
Section 1. The concept of leverage.
So in everyday physics, right, a lever helps you lift a really heavy object with way less effort. Well, in business, our source material notes that leverage is fundamentally a double-edged weapon. If a company is earning a profit, leverage is incredibly beneficial. It literally accelerates those gains. But, and this is a massive but, in the case of a loss, because leverage relies on a fixed burden, meaning costs that you absolutely must pay no matter what, it will actively and aggressively further increase that loss. The stakes here are just incredibly high.
To put a formal definition to it, leverage is a firm's ability to use fixed cost capital, like debt or loans from a bank, or fixed operating expenses, alongside variable capital, to basically magnify returns to their shareholders. Think about it like this. Leverage is really all about using fixed, unmoving elements in your cost structure to force a disproportionately massive change in your final earnings. It's like a giant multiplier effect. Now, understanding the textbook definition is great, but it brings us to a really critical, practical question. How exactly does the internal, day-to-day engine of a business actually magnify its operating profit before any banks or lenders even get involved? Section 2. Decoding operating leverage. Okay, so the entire foundation of operating leverage rests on the mix between your fixed and variable costs. Fixed costs are things like facility rent and your core administrative salaries. These bills must be paid regardless of whether you sell one single unit or 1 million units, right? On the other hand, we have variable costs. These are things like hourly production wages and raw materials, and these vary directly with changes in your sales volume. So a firm that heavily relies on fixed costs relative to its variable costs is said to have a high degree of operating leverage. Let's actually walk through the chronological financial flow to see how this works mathematically. It's pretty straightforward. Step 1, you take your total sales and you subtract your variable costs, which leaves you with what we call the contribution. Then, step 2, from that contribution, you simply subtract your fixed costs. And what you are finally left with is your EBIT, that's earnings before interest and taxes. This simple flow is absolutely crucial to grasp because those fixed costs sit right there in the middle, acting like an anchor. Now, what's really interesting about this calculation from the source material is how perfectly it illustrates that magnifying effect we talked about. We are looking at a company with a fixed cost of 2,000 rupees modeled across 3 different situations, selling 150 units, 250 units, and 300 units. Notice how the fixed cost stays stubbornly right at 2,000 rupees across the board, while the sales and the variable costs go up and down. Because that 2,000 rupee deduction literally never changes, any increase in the contribution margin drops straight down to the EBIT line, heavily amplifying the percentage change in profit compared to the initial percentage change in sales. If you look closely at that third situation we just ran the numbers on, the final degree of operating leverage, or DOL, reaches 5.3. Now, a DOL of 5.3 means that for every 1% increase in sales, the company's operating income, its EBIT, increases by a massive 5.3%. So high operating leverage means a relatively small bump in sales volume creates a massive bump in operating profit. But hey, remember that double-edged sword from earlier? Yeah, a 1% drop in sales means a brutal 5.3% drop in profit. Ouch. So we've seen how fixed internal operational costs act as a powerful multiplier. But what happens when we apply this exact same magnifying logic to the external funding a company relies on? Let's step outside the factory walls for a second and take a look at the balance sheet. Section 3. Understanding financial leverage. If operating leverage is the internal engine, well, financial leverage is the high-octane fuel poured directly onto the fire. It occurs when a firm uses debt funds along with equity capital. Specifically, it is the ratio of fixed interest-bearing capital, like debentures or bank loans, to variable interest capital, which is equity.
And just like fixed rent magnifies operating profit, fixed interest payments on debt magnify the ultimate return to the shareholders. And we measure that as earnings per share, or EPS.
Taking a look at this next illustration, we have a company with 10% debentures worth 200,000 rupees sitting in its capital structure. Basically, this means they owe a fixed interest payment of 20,000 rupees to the lenders no matter what happens. See how that 20,000 is subtracted from 3 wildly different EBIT scenarios? Because that interest payment is locked in stone, when the underlying business performs well, the final EPS absolutely skyrockets. And why is that? Because the debt holders only ever get their boring fixed 20,000 rupees, which leaves all the exciting excess profit strictly for the shareholders. So, the crucial point here is the degree of financial leverage, or DFL, seen in the middle situation of that calculation. A DFL of 1.33 means a 1% change in operating profit leads to a 1.33% change in earnings per share. It perfectly quantifies the risk and reward of taking on debt. Management is intentionally taking on a fixed financial burden to magnify shareholder returns. It's a calculated bet. Now for the really fascinating part. We have operating leverage, magnifying top-line sales into EBIT, right? And we have financial leverage taking that EBIT and magnifying it into EPS. So what is the ultimate risk when a business pulls both the operational and financial levers at the exact same time?
Section 4, the combined leverage multiplier. Let's see how this builds, because it's actually a very elegant 3-step journey. Step 1, operating leverage, takes a change in sales and magnifies it into a larger change in EBIT. Step 2, financial leverage, takes that already magnified EBIT and magnifies it further into EPS. Step 3, combined leverage simply multiplies the two together. It is the direct mathematical link showing exactly how a single percentage change in top-line sales affects the absolute bottom-line earnings per share. Let's put some real numbers to this ultimate multiplier with another illustration from the source material. The company here has calculated an operating leverage of 1.48 and a financial leverage of 1.39. Now, to find the combined overall impact on the business, you don't add them up. Actually, you multiply them. 1.48 times 1.39 gives us our combined leverage. This demonstrates exactly how fixed operational costs and fixed interest costs compound and work together in the background of a business. And the result of that multiplication? It's 2.06. This final combined leverage metric means that for every 1% change in sales revenue, the earnings per share for the shareholders will shift by a substantial 2.06%. Think about that. A 10% jump in sales, the EPS jumps over 20%. But a 10% drop in sales, the EPS plummets by over 20%. This dual lever system is incredibly responsive, for sure, but man, is it highly volatile. Section 5, significance and limitations. Okay, let's bring all this theoretical math back down to earth. There are very tangible pros and cons to playing with these levers. On the plus side, high leverage maximizes your earnings per share during economic booms, ultimately leading to wealth maximization for the owners. Plus, you get vital tax relief because interest payments on debt are actually tax deductible, which makes debt a cheaper source of capital than equity. But the downside? Well, there's nothing that induces panic quite like a looming, unyielding fixed payment when your sales suddenly dry up. During economic recessions, a firm saddled with high fixed obligations faces massive liquidity issues. Higher fixed costs also shift the company's break-even point higher, meaning they simply have to sell a whole lot more units just to survive. Ultimately, volatile income combined with unyielding fixed payments creates an extreme risk of bankruptcy. And this brilliantly illustrates the strategic balancing act for management. According to our source material, an ideal situation for maximizing return while minimizing risk is a blend of low operating leverage and high financial leverage. Keeping fixed operational costs low allows the firm to reach its break-even point easily with minimal day-to-day business risk, which safely gives them the breathing room to take on debt to maximize return. Conversely, the risky mix is high operating leverage paired with high financial leverage. That combination is an extremely dangerous multiple, where literally any slight dip in sales can wipe out the company's earnings entirely. In corporate finance, it is all about finding that perfect, sustainable equilibrium. So next time you evaluate a company, whether you're investing or maybe you're on your own business journey, will you look beyond just its top-line sales growth and ask, how sharp is its double-edged sword of leverage? Understanding the unseen fixed costs, pulling the strings behind the scenes really is the true key to financial mastery. Thanks so much for joining me on this explainer, and keep learning.